A 1-bar interval would of course be useless. The 14-bar interval doesn't cover many significant features before the 2.029 low, but it does cover important features in the development of the current uptrend. This is quite common and highlights why it is preferable but not necessary to have the interval cover major features before the swing point the time interval is based on. This interval is useful in both uptrends and downtrends to approximate when major support and resistance can be reached. After price reaches significant ranges near an interval line, it is a matter of watching short-term price action in the broader context to see whether support reverses the downtrend. It is preferable to move 2 decimal places to the right for a much larger interval, roughly 100 times the original rounded square root. This choice is less common as it does not necessarily identify the time of the most significant features on the chart. Such a large interval misses a lot of details, but can be useful in combination with similar intervals to see where more interval lines tend to converge, similar to the convergence of multiple Fibonacci levels. The bullish reversal is slow to begin, but once it gets going, it accelerates quite rapidly. This event is approximated by the wider area of downtrend lines intersecting with an interval line. Generally, the greater amount of intersections of trend lines, interval lines, and significant price levels increases the potential to identify an approximate area and time of significance. The times of some significant events are still identified much later on. Using a new interval based on the 2020 lows can be another option if a more recent feature is preferred for analysis. The primary duration of the 22-bar interval is theoretically more effective for the length of the downtrend since the interval is based on the peak at 4.929. That means there is a bias towards more events concerning support, upswings, and possible bearish continuations, rather than a focus on downswings and possible bullish continuations taking place close to the time of the interval lines. Here is another case where a larger interval covering over 100 bars is less useful. That is not to say large intervals are always bad, but they generally have less use, especially on a chart like this where there are sharply contrasting phases of large price movements in between periods of prolonged ranges with many small swing points. It can be helpful to go to a longer time frame, such as a weekly chart, when using intervals more than 100 bars to place more emphasis on the larger and more significant features on a chart.